Welcome. This is the Trading Pay, your home for sophisticated takes on the crypto markets. It's June 1st, our first show of June, and here in the studio, JJ and Ben Lilly of J Labs. I'm your host, Marconi White, and this month is gearing up for some volatility and the loud or soft answer to should you have sold in May? I don't know. But first, it's rapid fire, where I look for simple answers to complex questions, get these guys revved up. Hope you guys are ready to be in the hot seat. Ben, I'm going to kick it off to you. Chamath Palihapitiya, I know I probably butchered that name, CEO of Social Capital, says Bitcoin could hit 500,000 by 2025 based on previous halvings. Is this reputation suicide to call it this big from a account this large?
You would think so, but the bigger the number, it tends to bode well for influencers.
Unbelievable. I mean, I see it all these calls and hey, listen, we all like to get bullish, but it just feels like there should be a little bit, I don't know, some kind of reputation harm or something if you're going to get it wrong, but we'll see. We'll see. Hey, if it hits 500, we'll all be happy, right?
I doubt it, but yeah, we would definitely be
there
happy.
We go. JJ, leverage. Are traders using too much or too little?
I think like any drug, it's abused. Derivatives are definitely a drug, so I think that's what happens there. Gets overused and not for its intended purposes too often.
So after this season, are you going to open a house for recovering leverage addicts?
Yeah, halfway house.
Halfway house. Okay. All right. I think that's a good business. I think you'll know exactly who
Get
to
people
talk
outside, touch some grass.
Feel some sun. Ben, X account Trade the Flow reports that ETH ETFs could net 1 to 7 billion in year one. Is this bullish enough?
Yeah, it is. Based upon how ETH is set up, I don't think there needs to be that much demand to really push the needle here. And that's plenty of bullishness.
First we get the ETF coming through, surprising everyone. Then we get the flows coming in being a lot lower than what they would expect to matter, and then just blowing off the top. That would be interesting. We'll have to see if that how that plays out. Of course, we have a while until they start to come through. JJ, Roaring Kitty, market manipulator or savvy investor?
What's the difference? You're only a manipulator if you get caught. Otherwise, you're savvy. It's like that Cartman bit from South Park. It's only cheating if you get caught. Otherwise, you're savvy.
Oh my gosh.
Look at the Bill Ackman model. Remember, he went on CNBC at the COVID lows, screaming the world was ending. Meanwhile, he's buying up every stock that he could. It's the game. He's doing it quite well right now. So savvy.
So if he worked at a fund, this would all be legal.
Yeah, exactly. If you have enough of a backing and political power, it's savvy. If you're a retail person, it's manipulation.
Okay. Well, oh man, that's funny. That's going to be the best quote of the day. Ben, E-Trade reportedly yanking Roaring Kitty from their platform after he nets millions in positions. What's the best revenge if this happens?
Oof, if another platform is welcoming to that community and possibly generating significant flow and revenue from it. I believe we saw Robinhood do something similar with Doge and just absolutely crush it on their earnings. That would be suicide for E-Trade.
God, I'd love to see it. I mean, it's just another, I think Will Clemente put out, this is just another reason that everything should be on chain. So you don't have to worry about getting kicked off. JJ, last question here. Coinbase Wallet just published a new feature that lets you text meme coins to friends. Is this degen nirvana?
I'd say so, yeah. It's a way to share culture with one another, pretty low cost, and a way to assimilate people that may not be familiar with it. So I think it's a good thing.
Is it gonna bring on the next million degens, the ones that could be heading to your halfway house at the end of the cycle?
Yeah, it's a good starting point. That's for sure.
Okay.
Pill your friends without the backlash.
Yep.
We're gonna see how this works out for them, but always glad to see some innovation. Although I guess some is probably better than others. All right, well, let's get started. Today we've got an interesting show. We're going to be starting with the outside forces, looking at the Dixie oil, what's happening with some of the real estate and the banks. Then we're going to be breaking down the market with Bitcoin and Ethereum. Finally asking ourselves, is there enough credit and liquidity for this market to go parabolic, and looking at some positions. Before we do that, I want to give a shout out to Taipan, Adrian, Paul J, David, Light Signatures, I369, 251 Legacy Trail, Gary, Hello World, Ahamam 108. Apologies if I got that wrong. JB, Gabriel Nicola, JV. So glad to see you guys here. Hit that like and subscribe button. Definitely let us know what questions you guys have. Love to see what we can answer. It looks like some of you are trading Taipan. You got some interesting trades playing with the short, the copper, long, the sugar. Love to see it. All right, so all eyes right now are on the outside forces. We got the Dixie we talked about last week, looking to break down or break up above 105, break down below 104. I checked this morning, it was still in range, 104.24. We just had news coming out that OPEC has agreed to increase production, which is going to lead to a drop in oil prices. Same time, we just had another report coming out around the FDIC saying that they're continuing to see unrealized losses at banks continue to climb. And we saw GDP just be lowered from, I think, 4% down to 1% from Atlanta. JJ, when you look at all this picture and you're looking at the Dixie, what is it telling you? I mean, we're going to start to see some real macro events that create some volatility, or is just because it's going to continue to drag out as we range between 104 and 105? Oh, JJ, we can't hear you. I'd love to be able to hear you because I think you're saying something important, but we seem to be missing you. All right. Oh, no, we're still having an audio problem. Let's see if we can come back. Ben, I want to bring you up here as JJ starts to try and fix his audio. I gave the same backdrop. You put out a tweet yesterday about the dollar breaking its parabolic trend. What's your thoughts on where the dollar sits right now?
It's, that was an interesting move. It's been forming this kind of parabolic shape for about a year and been watching it with earnest and seeing how the crypto markets been reacting, and the crypto market has been respecting essentially that trade pattern over that year. And whenever it does have that bounce, I don't have it on my screen right now, and if anything, actually I'm showing something else, but I'm still going to pull it up here so we can talk about it. But the market did have V-shaped recoveries on the DXY, and then you would see softness or a correction show up around the same day or shortly after in the crypto market. But what was interesting to me was the comment you made on oil. And so we're going to uptick the supply into the market, and that created softness because now more supply, if demand's the same, then price is going to be coming down. But then you had DXY as well as the 30-year yields follow suit. And this has been a trend that's been going on again for the past year. So you're almost having this correlation take place in the market. It's very close to one. And when the market starts to get highly correlated, you have to ask yourself what's driving that correlation. And that tends to be when one entity and everybody's just sitting there waiting to hear what they have to say, which is where, I hate to say it, the Fed comes into play once again. And so I think this whole past couple of years now, with all eyes on the Fed, I think this is starting to gear up once again for everybody to wait to when they're going to give this sign that softening is coming, because you have central banks around the globe kind of already taking that first step. So is the US going to go ahead and do it? The charts are starting to hint at that it's coming. And you made some good comments. Marconi is along the lines of GDP getting revised. Oil's starting to soften up, and that probably also has to do with lower demand expectations. If you look at the forward curve for oil, that's lower as well, would hint at lower expectations for oil consumption. So it's it almost feels like it's a bit of a coming to Jesus, if you will, that what, all of this bullishness, all of this strength in the economy, it's getting ready for that little down tick, kind of that reset that we've been waiting for, kind of a lower on the peg action. So what's going to happen? It's going to suck out some of the credit in the room. You might have some BKs. You might have some people start getting kind of crazy and run around with their head cut off sort of mentality. But I don't think it's going to be anything too quick. It will just be a quick presser from J Powell and everything will be fixed.
So in your mind, they already have a game plan ready for when the stress finally hits the system. They see the crack, they see the liquidity dry up, and they're going to be able to run that.
Yeah, you shared. We were talking, I guess, yesterday a little bit about some of the unrealized losses that's being held at banks when it comes to kind of real estate. And if you look at debt and essentially its importance when it comes to kind of national security, at least for the US, and I think financial interests are one of the main, priorities for that security. You have the treasury debt being number one. And number two is mortgage-backed securities. There's just so much debt, and that collateral acts as financial plumbing through the whole ecosystem. Are they going to let those unrealized losses take the economy down? They're not. They're going to go ahead and make some subtle adjustment when it's necessary, create that unrealized loss, just like they did with treasuries, right? This is similar to what we saw with SVB back in March of last year, where there was a lot of unrealized losses happening. And then essentially anybody that was participating in the market, they were like, you know what, I'm not going to be participating because I don't want to deal with this debt. So liquidity dried up. And so we don't want to see that happening when commercial real estate loans start rearing their ugly heads.
No,
so
we
you'd
don't.
have to see some sort of action take place. Hey, you know what? Those unrealized losses, the Fed's going to go ahead and step in. We'll go ahead and accept parity on those things, and then you'll see the market just rip.
Hey, can you guys hear me?
Nah, yes, yeah, JJ, you're back.
Cool.
I know you went on mute because you didn't want to show too much alpha all at once. Okay, so Ben just broke down what the market looked like. He talked about the parabolic shape of the Dixie going weaker. Also, the fact that the Fed likely has some kind of plan already in place as this gets weak. But we've got a bunch of I would say challenges for the macro economy that if we don't see some liquidity come in, I think it's going to be a challenge for some of these policymakers to continue to drive growth or hit their objectives. But I guess from a technical perspective, which is JJ, where I was coming to you, we've been continuing to look at the Dixie, asking, is it going to break below that 104, maybe heading to 100 and below, or is it finally going to do the 105? What does the technical look at right now? And I'm kind of curious if you're a little bit surprised by perhaps the fact that it hasn't made a decisive move.
I think we did see the decisive move yesterday. So we finally saw it break down below the 200-day moving average at 104.40. I believe we have the JOLT job data coming out here at 10 o'clock. So I think that'll be obviously pivotal. Maybe it's going to come up and retest that lost 200-day moving average. But so long as it stays below there, like it continues to reject from that range, it's going to ultimately trend lower. We see it lost the 50 RSI mark. And again, this just seems like seasonality, which is something we were pointing out. Even as the dollar was running hot last month, we were saying typically the summer months, for whatever reason, people don't use oil or whatever it is. But oil tends to fall, the dollar tends to fall. We see this kind of time and again in the early summer that these things go through downtrends. And we see how clean the breakdown's potentially looking here on the weekly chart. So as you zoom out, you see this is kind of like the final ledge of support here. And if it loses this, the odds are it's going to trend towards that 102 lower Bollinger Band. You see it's still resting right on that 50 RSI mark. If it falls below it, I think it's going to open up the gates to potentially fall and retest the 100 range again throughout the summer months. So that should be, like, we already saw the reaction from Bitcoin, right? It wasn't obviously a decisive break over 70K, at least not yet, but we did see it move up pretty substantially after the dollar started to decline on Friday of last week. So just pull up a quick chart here. Bitcoin was trading around 67, and then we saw the dollar reverse as futures opened. And then yesterday's macro data came out, weakened it further, and Bitcoin shot up. It obviously went above 70K, then rejected, but it's still substantially higher than it was just on Friday. So this correlation can take a little bit of time to play out, but I do think just based on this historic relationship between the two, if you see Dixie slide below 104, that should be increasingly bullish for Bitcoin, and it should lead to new all-time highs. It's just a matter of timing it. It seems like it's testing patience right now, so could be soon.
Yeah, so break that down a little bit further. You say it's all about timing, and it appears that the dollar is going to continue to grind. Ben just mentioned a couple of scenarios where perhaps we see sort of a wick of some kind, sort of an acceleration on the volatility front, maybe see that Dixie go lower very quickly. Right now, it feels like it's just very much a grind time. And if you're talking about seasonality, I'm not expecting a black swan event to come in and sort of completely change the markers. So what are you looking at this over the next couple of weeks to really grind down to levels that would propel Bitcoin higher? Are you expecting something maybe over the summer?
I think ultimately what the market's waiting on is we have CPI next week, followed by the FOMC. So that's going to be a pivotal week, and I think that's what will likely cause the final flush lower for DXY, and the market can kind of get that confirmation it's looking for one way or the other. If the Fed comes out and says, hey, yeah, we are going to be cutting rates in July or September, maybe they do a surprise cut next month or next week, who knows. But the market's just waiting for that final confirmation that, hey, yeah, like all of this macro data that's been coming in that's showing signs of deflation, struggling job losses, decreasing inflation, that the Fed acknowledges it and they're prepared to cut in synchronicity with the other central banks. And I think that will ultimately be what sends it towards 100.
So I want to take that, Ben, and just get your final thoughts here as we're talking about outside forces. I think we saw the ECB was looking at a rate cut. There's a discussion, I think, by Michael Cowell, who talks about the fact that the Fed would not be outdubbed. It would be the last one to actually do rate cuts. I think we had a question here. How soon are the rate cuts actually going to be happening? And you've been talking about for a while, they probably won't happen until we actually see. I mean, obviously, anything that was systematic, if everything just broke down, certainly we would see some pressure for that to happen. But what about the fact that you were saying more of, listen, once they start talking about rates going up, that's when we can actually start to see those rates come down. Do you think that there's added pressure now that they're going to be looking to accelerate that? Or is the inflation risk of it staying persistent just too high?
If this, GDP revision, the unrealized losses start to spread out and become a little bit of a contagion risk, I do think you would see some sort of action on just 25 basis point cut to pacify market concerns, to kind of show up on the charts as bullishness, and then probably some sort of policy to just change some accounting standards as it relates to essentially whatever's on the books that is not looking the best at the time. And I think that would smooth things over. As far as like where we're at, JJ kind of said the big move happened. For me, it's, that was like the first leg of what a big move could be. Like right on my screen, just looking at the past year, you can kind of see the similarity. Like once this top formation and you kind of get the right shoulder, if you will, of, hey, like we're softening up here. And then you have the big move again, right shoulder, softening up. And then you start to have that big move. Similar, looks like back in February. And we're kind of having it right here. And so if you kind of think as that right shoulder retest of the distribution, if you will, pattern, same thing back in June of 2023, right? We did that retest. And then as we sold off on the Dixie yesterday, you had Bitcoin show some strength. And it wasn't the whole crypto market. The fact that it was really Bitcoin showing the strength relative to the rest of the crypto market, I think really creates this narrative that Bitcoin could be ready to run hot if we see some stress in the financial industry. I think that's something to really pay attention to in the next few weeks, because that would really bode well if GDP does start to soften up, if we start to see those concerns start to materialize. Because sometimes it can go either way when it comes to Bitcoin and crypto at large. If there is financial stress and liquidity concerns do exist, and we look at Bitcoin essentially as when liquidity is super high and things are moving hot, Bitcoin is going to benefit. But if there's financial stress, is Bitcoin going to be able to overcome that and create this narrative as, hey, this is the greatest, hedge to what's happening in financial markets and all this debt that's taken place and the high rates and having to refinance at these higher rates. This is all terrible. The world's coming to an end. Buy Bitcoin, right? Like that works at certain points in time during the cycle. And the fact that you had that bit of divergence yesterday is something to really pay attention to in my mind. So if Dixie goes ahead and continues this move and softens up, that would be really good for Bitcoin. And JJ and I, and as you too, Mark, we were talking beforehand about how Bitcoin, as well as Ethereum to an extent, hasn't really broken out like we would expect for this first week of June. Like it's kind of got everything ready to go, and everybody seems to be in a waiting pattern. So what are we waiting for? It's a big question mark.
It's testing patience, right? Like,
yeah.
And we see how clean the moves are. Like, look at how this is the CPI date when Dixie had that first major leg down. You just see how quickly Bitcoin reacted to the upside. So somebody's running an algorithm here, whatever it is, that whenever DXY weakens, you see this risk on appetite for Bitcoin. And potentially if Dixie is to fall lower, perhaps today on that JOLTS data coming out in a few minutes here, maybe we do see that leg up above 70K again, as it kind of swan dives down here and loses the bottom end of this range. We'll have to see how it plays out. But there's that correlation, and it's worth monitoring at all times.
So there you have a couple of scenarios of how this could play out if we see some acceleration or if we just continue to see a grind. So definitely check back Tuesday and Thursday, see what we're seeing from the outside forces. I think it's a good time, though, to sort of move in and get more specific to the crypto markets because we're a crypto show. That's what we do. So I looked at some of the data before, and I looked at the ETF data. They came in strong yesterday at 105 million in inflows. And over the last 2 weeks, every single day has either been relatively flat or positive inflows. We've really haven't seen any outflows. BTC this morning, I was looking at, was sitting about 69,000, ETH at 3,700, and SOL at 165. ETH BTC sitting at, I think about 0.5. I can't even read my writing, but it was basically the same bottom we looked at it about a week ago. JJ, you were just talking about the fact that this could be ready to run. We've been talking about this for several weeks now. Everything looks primed. I mean, what is telling you that we're, when we're actually going to be taking off?
Your guess
just based on the Dixie?
It might be that, right? It might, like, you see how close it is to a breakout here on the daily chart. We look at this Bollinger Band resistance. If it can catch momentum, I think 71K is basically the line in the sand. I think if we're able to get above 71K, particularly during the New York session, I think you could possibly see a parabolic move accelerate from there. But it's going to take some kind of catalyst momentum. Like, it seemed like yesterday, like everything was there and it didn't follow through. So that tells you that it's either distribution happening at this range, like people who bought pre-CPI a few weeks ago taking profits here, or people that didn't have a chance to sell back in March when we were at the 70K range, March and early April, using this as a take profit chance. So there has to be some influx of new buyers that overwhelm that supply. And ultimately, like you see, it's basically just been a large range here. So there's been a lot of profit taking. It's just a matter of, was that absorbed, and is it prepared to go higher now, or are we ultimately going to resolve lower, come back down and retest this 50-day moving average? I think it's on a shot clock here within the next 2 weeks. I would like to see it accept above 71K, hopefully this week. If not, I think the odds of it returning to that 65K level keep increasing with each day that we don't gain that momentum. Like, markets typically don't give you this long of an opportunity to get in before breakout. So if the breakout's going to happen, I do think it should happen relatively soon.
Is it possible that all of our signals are sort of starting to just be elongated? Everyone talks about a right shift or left shift in the cycle, but you shared the article that was from a couple of years ago saying the CME was going to tame Bitcoin and its volatility. We know that the ETFs are creating a new kind of structure slowly as more liquidity comes into the market, but it's paper Bitcoin. How does that impact your ability to forecast some of this going out just a couple of weeks or a couple of months?
Yeah, it's a institutional adoption. So you have to be careful what you wish for. Is that when you have larger players in the game, they're better at hiding their trails, right? And obfuscating price action and kind of keeping their motives hidden a bit. And then all of a sudden price will accelerate or drop rapidly once they're finished either distributing or accumulating. So there's always footprints, and you see it with the CME. Zero Hedge has been pointing this out pretty frequently. Just every day, it's kind of the same thing. They short it, and then they buy the ETFs, short it, and buy the ETFs to kind of suppress the price and get the fills that they want on the ETF. So it seems like there's a level of that happening. And then ultimately, when they're ready for it to move, they'll close those short positions, and you'll see it rise rapidly, similar to what we saw in like February and March.
Does that also have a shot clock at some point? Is that trade expired?
What do you mean by that?
Well, if they're buying the futures and shorting it just so they can cycle through and get the price at a specific target rate. We know, I think beforehand someone was reading, or maybe we were all reading, that 50% or so of the Bitcoin hasn't moved in the last year or so. We've got a lot that's very stale. So you don't have a lot of supply that's liquid, that's moving around. If that continues to stay locked up and the ETFs are looking for more supply, is it possible that it becomes a catalyst trying to short it and pin the price down at a lower rate or a lower price point?
Yeah, I think they look at it more as like a cash and carry. So as long as Bitcoin is below that resistance, they're happy to collect funding because it's not in a parabolic, it's not blowing out their short positions, and they're just collecting that funding rate, and they're happy to do so, right? As long as Bitcoin's in a range. But when it expands beyond a range, which would be like a breakout above 71K, then they'll probably close those short positions and let their spot profits ride a bit before they start to hedge again or take profits. So I think that's kind of the way this plays out, is they wait to see what price action does, just like everyone else. And ultimately it takes somebody to step in and start fat fingering it and hit on the bid and just drive it up. There needs to be somebody that's willing to take the leap and just say, okay, I'm ready for this thing to move. Give me all the Bitcoins, send it. But we haven't seen that impulse yet. And it's unclear of what the market's waiting for. Maybe it's macro data, maybe it's the FOMC next week. We just have to wait and see. But you'll see it in the price action, right? You see increasing spot volumes. You'll see the Coinbase premiums as we start to encroach upon 71K, and that'll be a good sign that, hey, like it's ready to do its thing again, similar to what we saw in February.
What about the options data? I have it pulled up here, looking at the Deribit metrics, and obviously we had a big expiry last week, the final week in May. I'm looking at this for the end of June, about 6.4 notional call interest, about 62,000 contracts. Put open interest is about 29,000. Max paying price is 54K, and we've got a bunch of calls going all the way from 75,000 all the way up to 160,000. So what's your take?
A lot of friction.
So break that down for the audience, because I'm not sure that they're going to understand those relationships.
So this is another reason why we're kind of stuck in the mud here, is that you see, like, anytime you see these large walls, right, like this call wall at 70K, this is essentially resistance, because ultimately somebody short that strike and they don't want to lose money on that trade, so they're going to protect that position. And you can see it in the dealer's positioning as well, and where they're long 67 through 69K currently, and then they're pretty short the 70K range. So as price gets into these levels where they're long calls, they're actually selling put positions against it to hedge these calls, because they're long one position. So to offset it, remain delta neutral, they're shorting. So unless there's somebody that's stepping in and taking the other side of that and driving it up, you kind of have this leveling out effect where you have a buyer and a seller, and it makes it hard for price to move. Like anytime you see these green bars, it's you're stuck in the mud range essentially. Until we get above that 70K and really a firm break above it, then you would see some hedging where if it gets above here, they're actually longing. They'd be longing to offset the calls that they sold at 70K. So that's another reason why we need to see momentum above there and kind of that impulse move. Until then, it's just going to be ping-ponging like this kind of crab market range where it's just a slow grind up.
Is that gamma concentrated on specific strike or expiration?
Yeah, this is just the current gamma profile. This one is for specific expirations. So if you take out, I could just look at this week's, for instance. Mm-hmm. So for the ones expiring Friday, you see they're pretty long 69K calls, and then they're very short 70K calls. Gotcha. So right now they're selling. When it gets above 70, they'd be buyers.
So JJ, I want you to answer the question, and then I want to get Ben's take on the institutional adoption. But when you see this kind of activity, we talked about the quote coming from the CME saying, hey, we're going to tame Bitcoin's price. You call it stuck in the mud. Is that what's happening here? Is that the fact that we're seeing an expansion of financial products and derivatives around Bitcoin, creating that mud effect or the taming?
Yeah, I think almost without a doubt. And we were talking about this last night. Like, what would the price of Bitcoin be if you wanted to buy Bitcoin? You had to actually buy it or sell it directly, right? Like if there was no derivatives, if you just had a pure spot market, I think it would be substantially higher. But when you add in all these paper products, it distorts price pretty massively, because then you can essentially rehypothecate it. Now you have what's an unlimited amount of Bitcoin when you add in the paper products, and I guess it creates a more efficient market. There's more ways to make money in terms of harvesting volatility and cash and carry trades and whatnot. So it's good from a financial perspective. But in terms of Bitcoin's actual price and true price discovery, it creates this suppression
dampens
effect.
It a bit.
Yeah,
It dampens it a bit.
A doubt.
Ben, What's your take on this institutional adoption having a dampening effect, as well as just opening the doors for perhaps different price action or other considerations that the market hasn't quite picked up on yet?
Definitely. And if anybody was around in 2016, 2017, and you remember how quickly price was moving, and more importantly, almost like the momentum that it had, and it was almost unbroken until December of 2017, which is exactly till that was the top right there. And I
That
think the
was.
rest of the market ran for another 2 to 3 weeks after that, especially Ethereum. That went hot for the next 2 to 3 weeks until January, and then it pulled back January 2018, and then it was the longest crab walk down till we broke below 6K at the end of the year in 2018. But when we think of like institutional adoption and we think of that time period, we can contrast the two. So you predominantly just bought spot, right? There were some leveraged markets, but your average participant, I mean, the majority of activity was around the spot markets. And so the main source of yield or returns was really associated with the change in price. But as a financial instrument, as an asset matures and essentially has greater utility in the financial ecosystem, its yield starts to come in various shapes and forms, right? This is the diversity of the asset. This is it growing and maturing. And so when we think of returns, it's not just on the change of price anymore. It has to do with what's the discrepancy on the funding rates. If you want to go ahead and lend the asset out because now it's being accepted as collateral by various desks and banks, right? And so now people are earning a return by just lending out the asset. And now you have ETFs that are generating yield off of Bitcoin. And so when we think about what's happening, it's really just Bitcoin's becoming a much more diverse asset, and returns are much more different than they were in 2016, 2017, right? And so that has a dampening effect because returns are realized elsewhere now. It's not just in the change of price now. So that's like a important caveat of like what happens to this asset. And so any asset that has not hit an ETF, I'm looking at you, Solana. If any asset has not hit that ETF status, right, there's less various forms of yield that exist in the market. And so that allows that price discovery to happen to the upside more so than it does with Bitcoin and Ethereum. So Ethereum, yeah, the upside could definitely get capped once this ETF does hit. And probably after this cycle, the returns on ETH are going to become very diverse. You'll see a lot of different products hit the market that start to generate yield in various ways, and that's going to definitely reduce the upside on it.
Ethereum. People wonder why it didn't outperform after the merge, right? Like there was all that narrative that it should go higher forever, like the decreasing supply, et cetera, et cetera. But I would posit the only reason it didn't is because of the call selling. Like you just had a massive overwriter of calls throughout the past 2 years, essentially, that was keeping price stuck because they owned so much of the supply and they could essentially extract extra yield from it by selling calls. And I don't think enough people are aware of like those factors of how people are able to bleed out extra returns from assets by selling volatility in various ways.
And that attention, by that, I mean, conspiracy theory, we were kind of saying it was an entity or two that was doing that, but
It's probably Lubin.
could be funding his organizations. But that interest in that activity around ETH itself, like that is no longer happening on the spot market and trying to play the changing in price. It's happening in a different manner. And so because of that interest and attention is being directed elsewhere, you're not going to see the same activity now because now returns are seen in various places. And so that just, it happens, right? That's a good thing for the asset. It creates price stability. And for everybody that wants applications to be built and find these great, user oriented products, like you need price stability first. Like once people start worrying so much about the change in price and they start focusing on building products to go ahead and drive more revenue generated off ETH coming into their ecosystem, then we'll start finding those products. But until now, until then, I should say, a lot of attention is going to be focused on this ETF, and for good reason. It's definitely going to move the market. Like if you're not paying attention to it, then it's kind of like, what are you doing? 50% of your interest wise. But what the point I really want to get back to is because when we look at price right now, and I think JJ's comment, like we're on a shot clock, is there's a lot of truth to that. You see the current formation taking place. It's starting to butt up against prior resistance. And then on my screen right here, I pulled up the difference between spot markets and the perp market on Binance. And I went ahead and looked up the CVD, cumulative volume delta. And so what that measures is if like you see in the tape, let's say a trade size that's for here, let's call it 20,000 worth of $20,000 worth of Bitcoin hit the tape, right? That activity and that action shows up on this yellow line at the bottom because it's falling within the bracket of any trade size between 10,000 and 100,000. And if we focus on the left side of this Panda terminal screen, and you look at the yellow line that I was just referencing, note how it just kind of goes sideways. And it's been going sideways since we topped out in March. And that shows a little bit of disinterest that exists in trades of that size. And the trades of that size tend to create like long trends in the market when you start to see it take off. And if you look on the right-hand side, we have this blue line there on the bottom, and that demographic is trades 1 million to 10 million. So significant size. And a lot of times you see that happening, those trades show up prior to larger moves. So this is kind of your smart money, if you will. And you're seeing a bit of a divergence form. And you're seeing it on the spot side, on the left-hand side as well. So it's almost like you're getting the conditions ready for a breakout, right? And you need to now see the next demographic kind of follow suit, which would likely happen probably hours to a day before the breakout would happen. You would see this yellow line start to tick up, and then you'd see kind of the rest of the market follow suit. And so if we don't see that second kind of following suit, if you will, of those participants in those types of trades hit the order book, then I would be a little bit concerned here. But if we do see it, then we could get a nice run, and then we could be off to the races.
Like looking at this, it shouldn't, if it's going to accelerate, go to all-time highs. It should basically be now within the coming days. Like it should break up above 71K. It shouldn't come. The market probably won't give you a chance to get back in at 68 or so if it's going to accelerate. If it starts to fade back below 68.5 or so, then it's probably heading to the 50-day moving average, and we're just in for a crab walk throughout June, at least the first half of June. So I think if it's going to take off, it should probably be happening here within the next few days.
So it feels like we're primed, as we've been talking about for several weeks. For any of those people that this is your first time listening, welcome. But this is the kind of stuff that we're talking about twice a week to really give people ample time to start to prepare for some of these moves, be it up or down. So something to think about. Ben, I do want to come back. So I think it's important to really clarify what you just said, which is that there's many participants in the market that are perhaps less concerned with price action moving certain basis points or percentage points day to day, and even having these all-time high. Like we started the show to talk about Chamath saying, oh, it could hit 500,000. They have a business model in which they can extract a lot of value, earning yield in other ways, right? Which I think is an interesting point for all those who are perhaps looking more at the price action perspective, being a trader. Perhaps. What about Ethereum? Makes a very interesting case. So whereas Bitcoin, you can get some native type of, you can use as collateral if it's going to be wrapped Bitcoin, and then bridge perhaps to another one of these solutions that's sitting perhaps on Ethereum, most likely on Ethereum, maybe on Solana. That's one thing, but that's going to be relatively small. When you look at Ethereum, it's got an entire ecosystem, right? So whereas with Bitcoin, you may have funds that are looking to lend it out and get some yield on what they actually own, going through traditional TradFi type of plumbing, maybe over-the-counter type of activity. Ethereum could have that plus this entire ecosystem. So what does that mean when that actually goes live and people are looking for yield?
I mean, at first blush, like for anybody that has been listening to my rants on Ethereum, and I won't rant here, but this is a good example of like what is the main difference between a lot of app tokens and layer one network tokens. Like if you take ETH, what are the different ways that you can use it? I know everybody hates saying, "Oh, it's only used for yield," but I'm sorry. I mean, that's kind of what currency is about. Store of values is trying to earn a return on that capital, on that asset. You know, is that bank going to go ahead and accept that as collateral? No. Well, you're probably less likely to hold it, right? Because it doesn't have, you can't store your value and go use it for other reasons and likely productive reasons. If you want to go ahead and just take some cash and use it as collateral, or your house itself to go ahead and make some renovations on your home, let's say, boost the value of that home. And so now the market prices the home and you go ahead and create some margin that you just captured from borrowing money over that time. You know, we can go to the chain and do something similar where you start to use these assets as collateral to go ahead and engage in various financial activities on the chain. Arbitrage is a great one. And if you go ahead and you look at Aave and look at what collateral they accept, and that you want to go ahead and start doing flash loans, like they're not going to accept all the collateral. And as far as the assets that they do, they have this whole risk rating system where if you're going to go ahead and use, let's say, the Brave Bat token, versus you want to use ETH, there's different risk parameters associated with that collateral. So you go ahead and you start to run the numbers and you want to get the most out of your money. Well, you're probably going to move it into a type of collateral that is less risky. So you can go ahead and engage in this productive behavior on chain. And then you can go ahead and you kind of go down the line and go look at how currencies are used on chain. So right now, I talk about Pendle and what's going on with, Eigenlayer and the ability to go ahead and earn yield, fixed or variable, or you can go ahead and go Eigenlayer directly and start to earn the secondary yield on your ETH. And you're suddenly lending out ETH as security. So people can go ahead and secure their layer twos. Like that's a very interesting way that you can look at collateral in creating a return. And it's not all having to do with the change in price. And so as far as money, collateral, as these different use cases form, the asset is likely to become more stable and have greater price stability. And so that return profile and how you're going to go ahead and use that asset is going to change over time. So yeah, you want to go ahead and earn, alpha and the changing in price. That's fine. ERC20s and go to other alternative layer ones and look at their tokens as well. You'll be able to make great returns in the next probably 2 quarters, 3 quarters. But if you want to go ahead and just, you already have a stash and you want to go ahead and lock in capital, start earning, say 10, 15, 20% annually on that currency, then you need to kind of change your portfolio.
So what I'm hearing is that you're going to have a lot of people that are going to be able to really earn yield. You already have some of that already in the system. You just mentioned a couple of examples, either being Aave or Eigenlayer. And the fact that they can actually go out there right now today, and that's going to continue to persist after the ETF, that suggests to me there's going to be a lot of competition. That could actually be a massive catalyst for Ethereum's price in the near term. As you said, it's going to flatline perhaps over time as yield takes over from price action. But I would imagine that could, for a period, be a pretty good catalyst.
Absolutely. And you can also think of returns not in ETH, but I think we're going to talk about some plays later. So I might bring that up at that time.
Yeah, fair enough. I want to, before we wrap up here, I did have a question here coming from JV. Thoughts on state retirement funds and other large 401k products getting exposure to BTC? How do you quantify possible catalyst?
I think that's great because they're not going to be, they're not like hedge funds where they're buying, selling, hedging. They're just holding it. They're buying and holding it. And it creates kind of a more stable floor where it's not somebody that's speculating. They're more just investing in it for a long period of time. So that supply that essentially is removed from the market.
So I guess the question is specific to, can we quantify it? And my take is that it's a bit of a bullwhip effect. We start to see these funds get in, they get exposure. I think there was a video that went viral yesterday about this really boring discussion about a teachers union pension fund buying into the BTC ETFs and the rationale for it. That opens the door for other ones to do it. And, you know, I think that's great. I mean, you're talking about, like, you know, the fact that it's, you know, it can be boring, and that's okay. And it just adds stability to the price. I'm not sure you can quantify it. These build up over time. Is there a $1-to-1 dollar? Ben, we've talked about this offline. Is there a $1-to-1 dollar that if, you know, we see $1 million coming in, that means X in price?
That variable changes every day. That has to do
Yeah.
with liquidity. That has to do with how many Bitcoin are on the ask side. It has to do with how many Bitcoin holders are willing to go ahead. And I think you gave me a stat right before the show. You said 50% of supply hasn't moved in over a year on Bitcoin. Is that correct?
Yeah, I think that was the supply, one of the stats we were talking about. Yes.
And so when does that figure change? Does it change at 100,000? Does it change at
Right.
120,000? And so that's elasticity. And so as people want to hold that token for higher and higher prices, you're just allowing essentially that $1 to have a greater, you know, change in price. But as we actually see this cycle continue, you usually see essentially changing of the guard, changing of the hands, where you have people that have been holding for a year or 2 years. And this is really reflected in what's known as hodl wave charts. And you can see the last time that, like, a UTXO, which is essentially change from you go ahead and you spend $10 and you get, say, $2 in return. That $2 that you returned was change. And so if you look at UTXOs, that's referred to as change in terms of the last time that they moved, anything over a year. That starts to get smaller as the cycle starts to run hot. And now you essentially have new holders, which is these pension funds. And so really you're just changing the demographic of who that entity or person is. And so it's natural.
Yeah,
This
I
is
guess
good.
that, sorry to interrupt, but it looks like that JOLTS data was pretty bullish. You see this price action?
I do. I see Bitcoin running actually too.
It's coming up on 70K. Let's see.
Right in the moment, you're tuning in as news is being made, headlines
Yeah.
are being made. Okay, so hopefully that gives you some perspective, JV, in terms of the what the retirement funds, other 401ks getting in. It's very difficult, as Ben just mentioned, for the reasons he just mentioned, to actually quantify X comes in, that's this impact on price. I think the more important idea is the trend that we're starting to see more and more of these funds come online, be comfortable talking about their exposure to Bitcoin as an asset class, digital assets in general. Likely to see some of that flow also to go into Ethereum. Again, I think there's some questions about narrative, but I think Ethereum can overcome that. Hopefully the rest of the space can as well.
Just to add in something real quick, Marconi, it's just a Trojan horse. Hey, excuse me, pension fund, you have this cryptocurrency on your balance sheet,
Yeah.
right? Hey, how about this other one? Did you consider what it's doing? Like, it just opens the door up to the next one and the next one, and the discussion of what is Web3, what is hedging in your, say, fiat currency, you know, that you actually exist in. Like, these conversations are coming, and they're going to be coming across the board. And what does that mean? And I think that's that whole Trojan horse conversation that, you know, it's great memes, great image, but it's the truth.
Yeah.
It's a cool thing too. Like, they're saying, okay, yeah, we bought, like, we're not ashamed of it. We bought this asset. We believe in it. It's, you know, Saylor has some antiquated takes, but what he did by accepting Bitcoin really kind of paved the way for all of these other people to go ahead and start doing the same, which will eventually lead to Ethereum, etc. So I think it's just kind of dominoes falling, leading to the inevitable over time.
And that investment advisor is probably sitting in a really comfy chair, and then they look across the desk and they see that there's a second chair in the room. Right? It's not just one chair.
The chair analogy. The chair analogy. The famous chair analogy that goes around the world. I want to point out one thing that I think is really impactful here. The crypto markets, the people that participate, we're so used to news happening all the time, constantly looking for the next big thing. but the TradFi markets can operate at a different speed. I think they were just talking about doing one-day settlement, woohoo. But I don't think any of these networks that have come online thus far have actually incentivized advisors to actually push Bitcoin ETF. Obviously, the ETH ETF isn't even live yet. You add on that incentive beyond the fact that there's even access to exposure, and this continues to look different. So, if you think longer term, 3-5 years and what this can look like, it's a very different picture, and the momentum is there. So it's something to keep in mind. Obviously, if you're a short-term trader, you're looking for other signals, but I think it's all very positive, very bullish for these assets. Let's move in to talk a little bit about positions and the remainder that we have with the show. I want to get a little bit on the Bitcoin ETH options perspective from you, JJ. Ben, obviously, you were talking last time we spoke a little bit about L1s, maybe some of the research you were doing. I think I'd like an update on that, see if anything's kind of piqued your interest. And of course, if you guys have anything else you want to share, I think the audience wants to hear it. Before we do that, I do want to give a shout out to CoinCall. If you're interested in following JJ's journey on options, definitely set up with the link in the description. Open an account at CoinCall. You can do your paper trade, or you can even start doing it live. It's got an elegant interface, great competitive prices, and of course, as I always mention, it's what JJ's using as he's walking through either his actual videos, which are on our channel, where you can learn how to trade options and think about the strategy. Or if you're here and you want to understand a little bit more about the option chain, it's a one-to-one map. So it's a great way to start that journey, start trading options. JJ, I'm bringing it back to you. We talked earlier about the June 28th expiry for Bitcoin being a big month. I think over 6 billion in notional, which is the largest that I recall us reporting on. What are you seeing for Bitcoin right now? And then let's break down Ethereum as well.
The biggest thing right now is that implied volatility is very low for June. So if we look at these expiries, June 7th, 45, 46, anything below 50 is extremely low. Like Bitcoin is, when it's moving the way it did in March, say, it's around 100 vol asset. So you're basically getting a 50% discount here, but you're relying on some kind of big breakout happening. In terms of positioning now, so let me kind of explain the thought process here, because we did enter some positions over the weekend when Bitcoin kind of formed a lower high or a higher low here. I know it was around 67K. I told Benjamin we should probably get some 70K calls that expire in mid-June because the implied volatility was so low and like your invalidation was so close. I don't want to point those out. I don't want you to be our exit liquidity because we're probably going to be closing those out pretty soon. Some kind of exaggerated move here, but like that, right. These are the opportunities that you want to wait for. Like if you're trying to play a volatility type move, you wait for when your invalidation is very close. Like we were right on that 50 RSI. We had made the higher low, and it seemed like, okay, there's a pretty good chance of upside here, and the market's not priced for it. So if we look at, these were the calls we bought them somewhere around here, around 2,000 or so. And now you see they're at 3,000. So this is kind of the moves you can expect from options if you're able to time that volatility effect correctly. In terms of now, like you're really playing with fire, because you're basically, if you're looking at these, you're betting on a breakout above 72K. So you might want to look at something like that. It is extremely risky anytime you're chasing something that's already up. Like it's at resistance now. Typically, you don't want to be a call buyer at resistance, right? Because as we know, the majority of these things expire worthless. So you're basically betting on an outsized event from here that's going to lead us up to new all-time highs. So if you're feeling risky.
Yeah, let me break in there. What about taking the opposite plays? Is now a good time to be buying puts, knowing that we're coming up on a resistance? What's your thought process there?
I don't hate it because the same way invalidation was so tight over the weekend as we were at 67K, and it was basically like, okay, hold this level or you just get out for a small loss. You could basically do the same thing with puts here. So you could buy anything from 69 to 67K expiring in say 2 weeks. And if Bitcoin ends up rejecting from here, falling back to the 50-day moving average, those are going to probably hit you a nice 2 to 3x returns on those. And again, if you see acceptance above 70K, you can cut those and it's just a small loss. It's not like you're playing with leverage per position where you're on the hook for unlimited losses, right? You have a very defined downside. So I like the idea of buying a put here with a very tight invalidation mark where say it's if the price closes the New York session above 70.5K, you just close the position, you lose a couple $100, no big deal. But if you're right, you potentially make thousands of dollars, right? So it's all about finding those opportunities of risk and reward. And again, the IV is still very low. Like the IVs aren't jumping up a huge amount on this move. So that's telling you the options market isn't really expecting any kind of outsized move from here. And we wouldn't see the IV leap, I don't think, until we got above 71K, 72K. Then you would see kind of what we saw here in February, where it just shoots up and doesn't stop going up for a month or two as people pile in. So you see that call demand rush back in. Right now, there's very little demand for calls because the market's just expecting us to crab forever. So until we see that breakout above 71, 72K, that's when you see like the move happens and then people chase it. That's the nature of markets is, and that's kind of the key of markets is figuring out what kind of setup can give you that potential return where you're looking at something. It's like, okay, I think Bitcoin could go to 72K here and the options market isn't priced for it. Or I think Bitcoin could go to 65K and the options market's just priced for us to range between 68 and 69. So
you just
go ahead.
Yeah, so you just walked through kind of the thought process from a Bitcoin perspective on options. Definitely don't want to be chasing this right now, but maybe some put options, some downside protection could yield something. I think in the next couple of days. In fact, even if we see that spike, what about Ethereum? Is it following the same pattern? Ben mentioned earlier in the show that the dominance. I think you mentioned this. I may be making it up, but the dominance of Bitcoin's looking pretty strong. And it may move before the rest of the market. So is Ethereum, do you have the same play on Ethereum? Is it slightly different?
Yeah, Ethereum's much of the same. It's got a little bit higher IV just due to that outsized move it made a couple of weeks ago. But if you look at the June and July expiries, the IV is very low, which again, it's and we covered this in our latest options market update, is what people did after the ETF news is they bought longer dated calls, dated for September seems to be the date that's pegged for the ETF. So when you look at the term structure chart for Ethereum, you see a huge leap up when it comes to the September expiry. Let me pull that up here. And the summer months are pretty dull. And that's because people are selling summer volatility, not expecting a breakout to happen until basically the ETF launches. So you look here, July 64 IV, June 28th, 61, June 21st, 58. But then as you go to September, it's up at 67, and the end of the year, 71 and 73. And you have some really strange pricing dynamics, or at least the last time I looked at this, you did, in that like a December call at 5,000 is trading for $500. And you look at a July 26th call for $4,000 and it's trading at 315. So that's a massive difference, right? Like the implied pricing on the December call is 5,500. Your implied pricing on this 4,000 call is 4,300. So you'd be paying less to get exposure above 4,000 on a July call. If you think this could break out sooner, that's your better opportunity is actually playing the shorter dated option if you're expecting a summer breakout here, because they're priced very low due to people selling those contracts.
Okay. Some interesting plays that people can consider from an options perspective. Again, if you haven't, consider opening an account.
If you miss this current move, right? If you're looking at this now, it's like, oh, I missed it. I think, again, playing those put options in case Bitcoin continues to reject from 70K. And if it does reject from 70K, you could get really favorable entries on call options around 65K. And again, your invalidation would be very tight here, where it's like, okay, either it holds this line and continues upwards later in the summer. You could probably buy December calls for very cheap here, September, somewhere around that range, as opposed to chasing here after it's already made a large move up and those IVs are starting to creep up.
Don't chase. Don't chase. It's a recipe for disaster. Maybe that should just be the slogan for XC.
Yep.
All right. So there you have some options, literally, that you can follow from JJ. Definitely check those out. Not investment advice, but definitely just JJ's perspective on some option plays. Ben, we'll wrap it up with you. As I mentioned before, you had talked a little bit about L1s, maybe looking to get into those. Are you right now just going to focus more on like some of the trades that JJ just outlined from an options perspective? Are you starting to take some active positions in some L1s that you think could potentially ride if we see a market materialize this summer?
I have not. I'm kind of waiting. We have a model that we refer to as demand shock model, and it looks at essentially what's happening in a block. It looks at how much demand is coming in. It also, we have it's another one referred to as price level, which that model looks at essentially the computation taking place and the demand for that computation on a chain. So as the market wants for Ethereum, it would just be like a swap is 120,000 gas units. And then if you go to like Pendle on Ethereum's base layer, that's like anywhere from 500 or 400 to I think upwards of 900,000 gas, which is a very high intense compute transaction. And so if you look at the market's demand at a certain time, you can kind of get a sense of the demand, and it's very low. It's very low across the board. So those two models right now are telling us that basically users need to show up, users need to start transacting, and there needs to just be a catalyst to emerge. Until then, that's just kind of it's a waiting game before moving down into alternative layer ones and even Ethereum itself. Like the ETF is happening, and we noticed that it created a nice positive feedback loop. When that price starts to rise, we saw some of the models start to flash that they liven up as well. So once the ETF does get approved, we would expect to see something similar again. But right now, like the fundamentals across the board are not great on the demand side. The supply side, there's some L1s that look great. Ethereum looks great as well. Bitcoin's got a very unique supply situation with its long-term holders holding. So that's what I'm looking at as far as fundamentals and knowing when to enter the market. I would say that from plays right now that exist in the market, if I looked at Pendle yields last week, and I noticed that the market is underpricing variable yields over there. I think they're pricing implied yields are around 20% right now. Like even there was a new protocol, Karak, I think was the name of that one. I haven't dove into it. I've heard pros and cons of it, which is just hearsay for me. I haven't done my own research, so do your own research. But based upon prior drops that have happened, that yield should be more like 50%. And anybody that's been playing the variable side on Pendle has been doing a great job, especially if you were on EtherFi. These are 3-figure yields at the moment historically. Of course, the hard part is, can you sell the token once you receive it, because your yields are going to be impacted accordingly. And that's an area to look at least for me, because you still gain some exposure to ETH there. But one thing that's really interesting, as JJ was talking, and I took a glance at the JOLTS data that just came through, refresh the rate probabilities. And I'm sorry to do this, Marconi, but it's been a kind of a change here on the probability of what rates will be for the rest of the year. And as far as July and September, so I know there's a June 12th meeting, and I would expect that June 12th meeting to kind of set the table for, are we expecting a rate cut in July or September? Because the market can't really figure it out right now. So if we pull up July right now, we can see that we did see some change from about a week ago, that we would see a 25 basis point cut from 10%, almost at 20% now. So that's a pretty decent move. And then if we move forward to the September probabilities, we can see that over half the market is expecting 25 basis point cut now. And if you look at just a week ago, that was at 41%, and only 34% of the market is pricing in essentially no change. But this is where it gets interesting, is you fast forward to December, look at the discrepancy here. Look at how many target rates you have, and look at how, say, a 100 basis point change from now until December, that's starting to get priced in. So what this kind of tells me is, like, there's not consensus in the market around the current trajectory of any rate cuts, whether it be when it's going to happen or how much it's going to happen. And there shouldn't really be this much discrepancy. So I think what Jerome needs to do next week, or what he's going to do, is try to address this uncertainty. And I know uncertainty is sort of like one of the cards that he does play. But I think that uncertainty might play against him a little bit. And so I think he needs to get the expectations in check, because as far as kind of what he's been doing, if he wants to stay higher for longer, like, he really tries to create that expectation, right? But as far as, like, am I going to raise rates, historically, not moving forward here, uncertainty helped him. And he kept the market kind of on guard, on check, and didn't really understand what was going to be happening at the next FOMC. So as far as rate cuts, I'm very curious to hear what he has to say and see how this dynamic changes in the coming weeks. So I think some of the movement in the oil, Dixie, that we mentioned at the beginning of this show, it's related to these rates, and I think Jerome is going to be it's almost getting his hand forced here next week. So
let's see if he actually
tuned.
plays the hand. If we finally see some capitulation on the side of the Fed, we'll see. But definitely some. If you're looking for positions, the first half of what Ben was talking about in terms of looking at Pendle, looking at the shock that could be coming to those actual networks, and then. Very interesting that this is just on the news. We've had two news breakouts today, so definitely good on that. But with that, we're going to wrap it up. JJ, Ben, thanks for coming here, breaking down the outside forces, what those are looking like, and how those are going to impact the market. I want to thank everyone for joining us. Definitely be back on Thursday. We're going to be breaking down the market, bringing back Benjamin. He can talk through a couple of ideas he's seeing. We may have some definitive movement at that point, up or down. You're not going to want to miss it. This is Marconi White saying have some dry powder and be prepared. Ciao, ciao.